Hello and welcome to this month's Financial Markets Update. Well, March proved to be an incredibly volatile month for financial markets. It really was a case of two halves in respect of both the performance for equity and bond markets over the course of the month, albeit we did see a significant rally through the second part of the month that actually resulted in some quite strong investment performance for both equity and bond markets. So interestingly enough, despite the challenges that we saw through the first part of the month really precipitated around the banking crisis in the US, we did see some solid investment performance overall for the month of March. The issues that really investors were focused on shifted from inflationary pressures and where central banks were going in terms of interest rate program to the stability of the financial system. The risks associated with that, I think, is pretty much clear to everyone when we think back to 2008, albeit that the challenges that we saw occur in the US throughout the course of the month very different from what we saw in 2008. As I said, even though it really wasn't until bank regulators as well as US Federal Reserve stepped into the market to protect depositor funds that provided some stability for the banking system, and as I said, reduced the risks to the downside and further runs on banks in the US, particularly mid-tier banks. If we looked at the performance of financial markets, it was really only the REIT market that was significantly lower. This was actually on the back of one of those banks in the US, in New York City, commercial lending bank, Signature Bank, that collapsed. And this had a significant negative impact on REIT markets around the world. And we saw our REIT market down a tick under 7%. Global REITs were down roughly around about 3.5% over the course of the month. And they were, as I said, significantly impacted by a lot of that ongoing contagion risks associated with property markets more generally. Notwithstanding that, we look at the performance of asset classes over the first quarter. It was pleasing to note that we saw positive performance across all the major asset classes throughout the March quarter. Notably, equity markets, particularly global equity markets, both in developed as well as emerging markets, delivered very solid investment performance. And bond markets, again, both domestic and global markets, were also higher over the course of the March quarter. So from an overall portfolio perspective, as I said, the strength that we saw in equity and bond markets as well as REIT markets that were obviously hampered throughout the course of March, but were able to deliver a slightly positive return over the course of the quarter. That overall performance that we saw across all the major asset classes delivered some solid investment performance at a portfolio level. So really March, as I said, was very much a tale of two halves. It does highlight, as I said, some of those secondary risks associated with the speed of move by central banks that we've seen over the last 12 months or so in regards to interest rate rises, and certainly in our view does highlight that we are certainly closer to peak rates. And from a domestic perspective, we saw that the RBA kept rates on hold throughout the course of March at 3.6%. We think we've potentially got one, possibly two more rate rises here domestically. And from a US perspective as well, we think there's only likely to be two further rate rises coming from the US Federal Reserve. With the banking crisis, there's no doubt credit provisioning is likely to tighten, and in many respects that's going to do some of the heavy lifting that interest rate rises have already done over the course of the last 12 months. And again, it's one of the reasons why we think that central banks are closer to finishing increasing cash rates through the first part of this calendar year. So from an investor's point of view, as we move forward on the back of that, we think that it will enable investors to think a little bit more through the cycle. Certainly if the unemployment rate can continue to remain at current levels where it is roughly around about sub 4%, we think that that's going to be beneficial to both the domestic as well as to the global economy as we move forward. And we think that ultimately that's going to start to feed into the performance of financial markets. So despite the challenges that we saw in March, we think there are some signs coming through that we are starting to get some stability, both in terms of the rate cycle. We are starting to see inflationary pressures start to moderate. Yes, they are higher than where central banks would like them to be, hence our view that we still would need some further increases in cash rates, but we don't believe they're going to be material in the context of what we've seen over the last 12 months or so. And as I said, our view is that we think this will be by and large positive for financial market performance throughout the second part of this year into 2024, certainly if economic activity can continue to improve from current levels. As always, if you have any queries about your portfolios, please feel free to reach out to anyone in the team, and we look forward to catching up again next month. Thanks, and bye for now.